Welcome back. Today we're going to take a look at performance management, and in particular, the rate of return on equity and the DuPont model. This is all about understanding how performance works in organizations. And in particular, we need to know how to measure performance and how to replicate the best parts of it. Performance measurement is important. We have to have a metric that tells us whether we're doing better or worse. But more important than recognizing performance, we need to explain it. Because if we can explain it, we can reproduce it. Sometimes we have performance successes, failures that can't be reproduced, effectively one-off events. For example, if you win the lottery, that's a great way to get rich, but it's very hard to count on doing that 2 or 3 times in a row unless you have some special secret. This is all about creating shareholder value. Creating wealth for the shareholders is essentially the principal objective of management. Of course, when Milton Friedman said that in the 1960s, people listened and said, well, of course, that's the purpose of a corporation. It's to make the shareholders better off. Since then, we've realized that it's not quite so simple to say that as to do that. We have other types of stakeholders, employees, customers, the broader economy may also have a stake in businesses. And clearly we want to make sure that all of our stakeholders are made better off, or at least made whole, from the activities of our company. But we can measure the activities of the company, and so that's where we start. Shareholder value then becomes the principal objective. And to create that shareholder value, the first thing that we look at is our return on the efforts, the return on the work that we've done in the company. Whether that's a return on the assets, the total assets, the return on the equity, or some particular return on investment in a project. Now, the investment is all about the use of assets. And when we talk about assets, we're referring both to the return on the fixed assets, the plant and the machinery, but in many cases there's a substantial investment in working capital. That includes things like the inventories, the accounts receivable, the cash on hand, net of some of the current liabilities. Profitability is part of this, and here we start to take a look at the revenues and expenses. And we can put all of this together to try and understand how does a change in the profitability, or how does an increase or a decrease in assets affect our overall investment, and then how does that get turned into shareholder value. Return on investment, of course, is going to be a return to all of the investors. That includes the bondholders as well as the shareholders. And so financing is the other side of shareholder value. Are we using too much debt? Are we using not enough debt? And that's a phrase that we don't hear that often. Not enough debt? Well, typically the return on equity is higher than the return to debt. And so if we can borrow cheaply and then use that debt to leverage the returns for our equity investors, that's a good use of debt. Of course, too much debt, everyone knows, is going to be a bad thing. So what is the proper and safe level of debt? And if we're not using enough debt, perhaps can we use more? By the same token, we also want to make sure that we have got enough liquidity in the organization. Cash may be a problem. Some companies have billions of dollars of cash just sitting around earning a very low rate of return. And if they could turn that into fixed assets that would produce more return, then they would clearly do that. So too much liquidity, not enough liquidity. We want to have the optimal level of liquidity in the business. But let's take a step back and take a look at those profits. In particular, when we talk about profits, there's several different measures of return. Sales, of course, company has to have sales to have profits. And sales growth is one of the most important metrics of performance, especially in technology companies where we're expanding to fill a need that wasn't recognized before. So high growth in sales is an indicator perhaps of future profits. Profits from operations are the gross margin. Does our principal operating activity generate a return that can be used to cover some of our other fixed costs? So gross margin becomes important, especially in businesses like retail and manufacturing, where it's a metric that tells us whether or not that plant, that manager, is really doing a good job. Now, we get a little bit further down the list. In fact, we get to the bottom of the list and we start to look at the net income. How much profit is left after we have paid for our operating activities, paid for our overheads, paid for the cost of taxes and financing. That becomes the money that's left over that we can think about distributing to shareholders. But there are a couple of other ways to slice net income that are also important. For example, the operating profit, or EBIT, earnings before interest and tax. Similar to gross profit, except it takes out the cost of those fixed overheads. We also could add back the cost of depreciation amortization and use EBITDA. And you'll hear that term used quite often. It's a strange one. And in fact, you can see from this Dilbert cartoon, Dilbert's boss says, "What are you doing for the EBITDA today?" I'm trying to sound like a knowledgeable manager. Well, Dilbert really doesn't know what EBIT does, and the boss explains earnings before interest, tax, depreciation, and the other thing. In any case, you see what we mean. Amortization might be a significant part of the cost of doing business, especially if we have a lot of intellectual property built into our business. And sometimes when the amortization comes out, its purpose of being removed is to reduce taxes. However, the value of the intellectual property might have actually increased during the period. So it can be a massive distortion in profitability, and we want to add that back in. Whenever we're talking about performance measures, we have to remember a simple rule, that the measure that we use should be within the control of the manager. If you can only control operating decisions, we should be using EBIT. If you can control the operating decisions, and you can control the investment decisions, and you can control taxes, and you can control the financing decisions, if everything is part of your job, then we use net income. If you're a salesman, we use the gross margin. So the level at which we slice performance is going to depend on where we're looking at the company. At the operating level, the managerial level, at the country level, perhaps, when we're thinking about things like taxes. And that means you can calculate all of the ratios that we'll look at today using different numbers in the numerator. We don't always use net income, for example. Now, the DuPont system is named after DuPont de Nemours, a famous American company in the early 1900s and 1920s, right through until about 1930. DuPont had become a conglomerate who really didn't understand how they were making money. A young engineer in 1920 decided that this particular approach would help to identify the parts of the different business units that were doing well. In fact, it was a discovery that was sufficient to turn him from an ordinary engineer into the company's chief financial officer. And he worked with the top people in the organization to determine whether different units and different investments were really providing a fair return to the shareholders. And that's what we're going to be talking about today mostly. We'll talk about the DuPont system and how we understand the rate of return on equity. The DuPont system can be described as a 2-factor, a 3-factor, a 5-factor model. In a 2-factor model, we very simply look at the rate of return on assets and leverage, the financial leverage in the company. A 3-factor model, we look at things like the profit margin, or how well the company is controlling its expenses, asset utilization, or total asset turnover, TATO, you might hear it. And we also look at the use of debt, equity multiplier, or financial leverage. In the 5-factor model, we also include the interest burden and the tax burden. Clearly, if you're a manager who doesn't control decisions about where you're going to locate plant, and then you don't benefit from tax efficiency, we wouldn't use tax efficiency as part of our model. And if you don't make decisions about whether to raise funds in short-term bonds or long-term bonds or in the corporate lending market, then you wouldn't be interested in borrowing efficiency. For the purposes of our course, mostly we'll be looking at the 3-factor model: expense control, asset utilization, and the equity multiplier or financial leverage. These factors together will ultimately determine the rate of return on equity. And so we talk about the decomposition of ROE. ROE starts off by saying, well, this was our rate of return on equity. It went up by 5%. And ROE is just net income divided by the total equity. And so you can say, well, yeah, my net income went up and my total equity didn't change, so that's good. Now, why did the net income go up? Well, that's a great question. Net income, of course, is made up of parts. Our net income comes from our profit margin, but profit margin for most companies, for most products, is actually turned over several times during a year. If you're in the fashion business, perhaps you earn your profit margin 3 or 4 times a year, once in each of the fashion seasons where you buy inventory, you sell it, you move on to the next fashion season. So a 5% profit margin multiplied 4 times a year, 5 times 4, gives us a 20% overall margin. So the turnover of our profit margin becomes important. Our return on assets is determined profit margin times the asset utilization. In fact, you can see that in a model like this. Profit margin, net income divided by total revenue. Wait a second. Remember I said at the beginning, sometimes we can use different numbers in the numerator. For example, here we could use EBIT instead of net income if we're looking at a division within the organization and the managers don't control interest and tax decisions. So we'll stick with the simple model. That's what our textbook does. Net income divided by total revenue is our profit margin. So if we have $100 in net income and $1,000 in total revenue, 100 divided by 1,000 is a 10% profit margin. The asset utilization is about how many times a year you turn over your assets. If you're a Christmas tree retailer, you sell your assets 1 time per year. So you have $1 million in assets, $1 million in revenue. Your asset utilization is 100%, or we say 1 times. And if your profit margin was 10%, 10% times 1 means your rate of return on assets would be 10%. Other businesses have a much higher asset turnover. If you're a baker and you basically only have your raw materials, you turn those over 360 times a year, your asset utilization would be 360 times. So that's how we break down the return on assets. It's sometimes referred to as the return on investment. It's profit margin times the asset utilization. Here's an example that I provided in the spreadsheet that's available on VIU Learn, and it's also part of the handout that I've provided on performance measurement, performance analysis. This is Amazon. Now, this is real data from the last 2 years for Amazon. So we have the revenue and the revenue, the expenses, the key financial statistics provided for the years 2018 and 2019. We have the net income divided by the total revenue provides us with the profit margin. Our profit margin is 4.13%. And we've provided that number in the first box. And we see the asset utilization, which is the total assets divided by the total revenue divided by the total assets. And that is 125%. So 4% times 1.25, or 125%, means the rate of return on assets for the company was 5.14%. Now, is that good? You'd think that Amazon's asset utilization would be higher. We see that, in fact, from 2018 to 2019, the asset utilization has fallen. So they're turning over their assets less. Perhaps they're holding larger inventories. And we know that Amazon actually doesn't always sell their own inventory. They do fulfillment for other companies who would own the inventory. So what are we talking about here? Fulfillment centers, buildings, that they have in different locations around the world, especially in United States, Canada, other developed countries. And those are going to be expensive. So as their assets went up, their asset utilization has fallen. And that's part of growth. We're also interested in the profit margin, and we see the profit margin fell by a little bit. Not a lot, but from 4.33% in 2018 to 4.13% in 2019. Again, that would concern us, but that may also be part of the price of growth. When we take the profit margin and we multiply it by the asset utilization, we get the return on assets, and we see the overall effect of decreased asset efficiency and decreased performance efficiency means they've lost more than 1% of their rate of return on assets. Now, as a shareholder, I'd be concerned, but that concern doesn't mean that I don't like the company. That concern suggests that I have to provide an interpretation, and the interpretation might be that the company's growing, and the cost of growth might be lower efficiency. Many companies may fall into the trap of looking relentlessly for an improvement in rate of return on assets without thinking a lot about it. And here Dilbert's boss says we need to boost our return on asset ratio. Wally, the character with the square glasses, says let's eliminate the security guards. That would cut our expenses while allowing for a brisk reduction in assets. Yes, the assets would disappear, and we wouldn't have to pay for the security guards, so the profit would increase and the assets would decrease, and that would increase the asset utilization, increase the profit margin. Wally's a genius, except that his intention is basically to steal a bunch of stuff and furnish his house. That's not far off the truth in the way that managerial behavior often works. If we're looking at a company and we see their rate of return on assets has increased, perhaps that's because something's happened. Maybe they've sold off some of their plant and machinery and are now perhaps leasing back the equipment, or they've outsourced some of the activities. A very common ploy which will increase the rate of return on assets while not having great long-term implications. Or perhaps the company has reduced its inventories, perhaps by maintaining lower inventory levels, or perhaps by booking phantom sales. All of those things are possibilities that the analyst has to dig deeper for. Now, to get to return on equity, we expand this model a little bit more. We take the rate of return on assets, the blue boxes that we've already looked at, and we expand that by taking a look at the equity multiplier. Now, equity multiplier is simply the total assets, same number we used before, divided by the total equity. And so if a company has a high equity multiplier, essentially what they've done is they've said that we're using a lot of debt in our business and we're using financial leverage. So if we have 10 times as many assets as we have equity, that means essentially they're working with 1 part of equity and 9 more parts of debt. And so they have a 9 times multiplier. And that would give them a very powerful business, but a very precarious one, because one bad year they lose some money, they'll wipe out their equity. So equity multiplier, again, is a double-edged type of situation where we have improved performance because of increased leverage, but increased risk as well. And we have to interpret that as well. Now, for a company like Amazon, it's interesting to see that when we add in the equity multiplier, our financial leverage number, they have about 1.5 times as much debt as they have equity. They have debt. I can see from the notes here. Oh, sorry, they've got $62 billion worth of equity and only $23 billion worth of debt. In fact, that number's not changing from year to year, but their equity's gone up. So their equity multiplier has actually decreased because they're using less debt in the business. So 62 divided by 23 gives us our equity multiplier and 137%. Their equity multiplier, 1.37 times 5.14, gives us a rate of return on equity of 18.67%. Now, that's actually a big drop from last year where it was 23%. And the reason, well, the two reasons, well, first, the rate of return on assets fell. We saw that. But especially the equity multiplier fell. And why did the equity multiplier fall? Because their equity has risen. And more equity is not really a bad thing, but it also shows that if the company used more debt in their business, they could increase their rate of return on equity. 23%, 18%, both of those are great rates of return on equity compared to competitors, and so we're not really too worried. But not only do we know what's happening to ROE, but we know more about why it's happening. Now, this part is basically a three-factor DuPont analysis. And taking a look at the equations, basically from the textbook, we say that we have three factors: profit margin, asset utilization, and equity multiplier. And the simple calculation, net income divided by sales, or total operating revenue, and asset utilization, sales divided by total assets. That's ROA. We multiply that by assets over equity, and that gives us our ROE. The five-factor model, and again, this is not something that you have to worry about on an exam. The five-factor model is essentially a variation on the three-factor with a couple of extra factors added in. We still have got the financial leverage, asset utilization, and profit margin, these bottom three items. But we also are going to take a look at the tax burden, and that's net income divided by earnings before tax. If the company has no tax, the net income and the earnings before tax would be exactly the same. So basically, that would be a factor of 1. In a normal situation where the company pays, let's say, 25% tax, then we'd see the tax burden would be 0.75. And that means that, well, 75% of the return is going to the shareholders and 25% is staying with the government. A more efficient manager might find a way to move some of the locations into lower tax jurisdictions or take advantage of tax incentives from the government and reduce the tax burden. So typically the number will be somewhere around 1 and a little bit below that. The interest burden is earnings before tax divided by EBIT, earnings before interest and tax. And again, the higher the amount of interest that's paid, the higher the interest burden, up to 1 where the company has got no interest. And theoretically, for both of these numbers, it's possible to see a positive number greater than 1. And that's because you can get a tax refund or you can earn more interest than you pay on your debt. And if the company only reports the net interest, that number could actually be negative interest because they earned more than they paid. We don't really worry about that in this course, but this is a variation as well that you need to be aware of. Now, the purpose of doing all of this is so that we can understand how the company is doing over time, a trend analysis. Are they getting better or worse? And we saw what's happened in the last year with Amazon. But it's also useful to compare with other companies. And when we look at other companies, that tells us how they're earning their money and how it's different from their competitors. Sometimes that means they're doing better. Sometimes it just means they're different kinds of companies. Always we have to dig deeper before we get the real truth. Here's an example that's also provided in the teaching note where we compare the profit margin, asset utilization, the financial leverage or equity multiplier for 3 different companies. And they're not perfect competitors, but they're certainly companies that are often discussed in the same sentence. Amazon has not got the highest profit margin, but it hasn't got the lowest. And the highest profit margin of the 3 is Apple. And the average of these 3 companies was about 9%. Apple earns twice the average profit margin. That's why they're a green box. And Walmart is the lowest. That's why they have the red box around their number. We can interpret that a number of ways. Why does Apple have such a high profit margin? Well, because of the differentiated nature of their products, because of the fact that they only own part of the value chain. They are in the most valuable part of the business. They sell services that have very, very low cost of delivery. It doesn't cost very much to sell one additional song or one additional movie on their streaming services. So that may be part of the explanation for the higher profit margin. Asset utilization, though, you can see Apple does terrible. Well, that number is just wrong. 85% asset utilization. It says they don't even turn over their assets one time per year. Well, take a look at their assets. They have about 70% of their assets in cash. And that's because their business generates so much cash. They typically have about $190 billion of spare cash sitting around in the business. If we took that out, if we deducted the cash from the asset utilization, the number would be 3.5 times higher, so definitely higher asset utilization. That makes sense because Apple doesn't own a lot of its production capacity, it outsources that to other manufacturing businesses. Walmart, on the other hand, appears to have the highest asset turnover. Of course, they have brick and mortar stores. Those are going to be expensive. They have physical inventory that they have to maintain, but they're about turning over their inventory quickly. They turn over their inventory more than twice a year, or their assets more than twice a year. And so that's a number we'd look for to see if it changes from year to year. Amazon, somewhere in the middle at about 124%. In terms of return on assets, well, return on assets and return on equity, Apple is definitely the best with a huge number. Amazon actually is the lowest of the three. And, well, Walmart someplace in the middle. And again, one of the key differences here, equity multiplier. Apple actually has quite a bit of debt. They use bond financing to lower their cost of capital. And so for that reason, they have 2.5 times as much 2.5 times as much debt as they've got equity. And so that means the business has got more leverage. All three of these companies are doing really well. The rate of return on equity is much higher than the average for Standard & Poor's companies. So none of these is really a bad company. But of the three, Amazon is in the lowest position. DuPont Analysis is about interpreting the rate of return on equity and making sure that not only the company's rate of return on equity is strong and increasing, but making sure that it's done in a way that's sustainable. And we know that increasing debt can't be done forever. Eventually, the bondholders are going to own 99.9% of the company, and so the shareholder returns become irrelevant because the company will likely go broke pretty soon. So 1 year improvement in the equity multiplier, well, it might be a good idea, but it's not something the company can sustain. Increasing sales is always going to be good to a point because you can only sell so much depending on the products that you sell. Unless they're addictive, there will be eventually increased sales will result in oversaturation of the market at some stage. Increasing profit margin, again, a great thing to do, but very hard to do. In fact, of all of these things, the hardest thing to do is to increase your profit margin. Finding efficiency. And typically in the long run, would say that a company is only able to improve its productivity at a rate of about 1% per year. That's a good improvement in productivity. Increasing your assets, well, increasing your asset utilization rather, that's a good thing as well, but it's hard to sustain because reducing your assets or increasing your sales, both of those have limits. So yeah, we definitely like the profit margin. That's the best way to increase the rate of return on equity. That's essentially the DuPont analysis, but I should also mention that it's part of an overall broader analysis. When we're looking at a financial analysis of the company, we look at the trend and the variance, the difference between the company and its peers, the other companies, in several different dimensions. Is the company growing? Is it growing its sales? Is it growing its profits? And is it growing its earnings per share? How are we measuring the performance? Are we looking at operating profit, the net income? Are we managing the assets, the fixed capital, the working capital, even the human capital that's invested in the business? Is the company solvent? Is it liquid? Is it too liquid? Solvency essentially is a discrete measure. solvent or you're insolvent. You can pay your bills or you can't. Liquidity is more of a continuous measure. You can have too much liquidity, you can have too little liquidity, or just the right amount, or be anywhere on that scale. Have you got enough equity in the business to survive a bad year? Have you got adequate capitalization? And does the market like you? As we discussed in the last session, things like the market to book value ratio suggest that the market has got a lot of information, especially about some of the non-financial aspects of the business. And speaking of non-financial, we won't go through those today, but you can see there are many things, many aspects of the business that are qualitative in nature, eventually will be measured financially. Has the company got good products? Has the company got a good product pipeline with products in development? Do we have a good way to get those products to market? Are we part of a network where we can perhaps, sell our product through several different levels of retailers and wholesalers? And what does the market channel look like? Are our markets growing? Are we invested in the best places in the world, or are we invested in a stagnant and mature market that is not growing very fast? How about our technology? Is it a technology that is improving? Are we finding efficiencies? Are we leading with technology, or are we in a technology that's about to become obsolete? Competition isn't necessarily a bad thing, but clearly a fragmented competitive landscape with a lot of small players might be a problem, or one that's too concentrated, and the focus of antitrust measures by the government might also be a problem. Does our company have a clear strategic direction? Are we doing things in a haphazard way, or do we have clear strategic intent? That this is part of a plan that will lead from A to B to C and ultimately to global domination? Or are we just doing things because, oh look, there's something bright and shiny over there, let's chase after that? Have we got the right kind of human resources? Have we got a problem with demographics? And we can't find enough good employees because of a shortage of young people in our particular market. Perhaps we have to find a way to engage older workers to keep them working longer, or to recruit older workers as well. How about our clientele? Are we selling our product to a diminishing demographic? Is that going to be a part of our business? How about our management as well? In our business, do we have the right quality of managers? Do we have the best people in management and research and development and marketing, finance, human resources? Have we got all of those different functions covered? Have we got gaps? Perhaps we don't have enough good people in marketing, or perhaps we don't have enough people in R&D. And does our business rely on one or two key people at the top? Have we got a succession mapped out within the organization? Often you can see a company's share price falls because one particular feature of the business is missing. The company has not got a finance director. The CEO quits and the share price tumbles. Well, that's because we haven't developed the depth that the business needs. So, in summary, this video is supported by the material that's covered in mostly Chapter 2, and that's Chapter 7 from the Braley-Myers textbook that we're using in our custom book, and also the financial performance teaching note that's provided in VIU Learn. We say that within our broader analytical framework, ROE is important. But how we create ROE, is our return improvement going to be sustainable? That's going to be the most important thing. And ultimately, we're interested in the ROE because it's part of our most basic measure of shareholder value creation. We say that our company creates shareholder value whenever the rate of return on equity is greater than the cost of our capital. So if you have a 5% cost of capital and you have a 20% rate of return on equity, the company is creating value for the shareholders. And as we said at the very beginning of this session, as Milton Friedman very famously said, the purpose of management is to maximize the present value of the shareholders' returns. And management is doing a good job, and the share price will rise, and it's definitely going to be a good investment, a good place to work. I hope this has been helpful, and I look forward to seeing you in the next video. Thanks.